Index funds have grown considerably over the last decades, and in particularly in the last 4 or 5 years, they've become even more popular. Estimates now are that about 20% of the shares of the largest companies are typically owned by index funds, maybe even a little bit more by now, and that number seems to be growing up. The question that executives often ask, and sometimes investors, is, as the size of index funds increases and they own more and more of the shares, will that reduce the liquidity of the trading of shares, because they have to own the shares and they don't trade very much, and therefore will it impact the value of companies? There's a natural equilibrium that will occur, though. As the size of index funds increases, right? If liquidity does decline to the point where it creates misvaluations in shares relative to each other, relative to intrinsic value, that will create profitable opportunities for investors and money managers to make money and to beat the indexes. Right now, they can't beat the indexes, right? So if they can beat the indexes, then that would cause a shift back towards active management. So you can expect that index funds can rise in size until they reach a level at which they might, if they ever do begin to distort share prices, then that would be a cap at that level and we'll be back in some sort of equilibrium, and the sort of opportunity to make easy money will go away. Certainly something that executives should not worry about. You don't have to have that many investors, smart, sophisticated investors in your company in order to keep the share price in line with its intrinsic value.